One of the most common questions that I always get asked on social media is, Liam, I already know a lot about ICT concepts, but how do I apply them into a fully rules-based mechanical system? Well, in this video, I'm going to show you the exact blueprint to my fully rules-based momentum mastery system, and I've broken it down into 4 simple, easy to follow steps. And I guarantee by the end of this video, you're going to learn a proven data-backed system that you can implement instantly into the markets. Let's jump straight in. So this right here is the Momentum Mastery Blueprint. What I've done is broken down the system into 4 simple, easy to follow steps. And it's very important that you follow every step closely and you do exactly what the system tells you. The reason that so many traders are failing is because they're not trading a rules-based mechanical system. And so this system right here is fully defined and it takes all of the guesswork out of it. So step number 1 is a daily directional bias. Step number 2 is a liquidity raid. Step number 3 is confirmation, and step number 4 is stop loss and targets. Step 1, daily directional bias. And so many traders have problems with identifying their draw on liquidity or their daily directional bias. And so this simple, easy to follow framework makes it very, very easy for you. We have 3 potential scenarios in the market. Scenario number 1 is a bullish daily directional bias. This would be where the 50 EMA is greater than the 100 EMA, which is greater than the 200. This indicates long daily directional bias. And so we would only be looking for buy positions. So let's say that this is the 50 EMA, this is the 100, and this is the 200. This would indicate a long daily directional bias. And therefore the draw on liquidity would be to the upside. The second scenario would be if we were bearish in the market. This would be when the 50 EMA is less than the 100 EMA, which is less than the 200 EMA. This would indicate a sell daily directional bias, and therefore we would only be looking for sell positions. Scenario number 3 would be a ranging or no bias market, and this would be when the EMAs are crossed over. So let's say that the 50 EMA crosses over the 100. We would therefore not be looking for any positions in the market. And so this is a very simple way to define whether we're either bullish, bearish, or have no bias in the market. So many traders are looking at placing trades every single day in the market, but professional traders only execute trades in the market when the conditions are correct. And so knowing when to stay out of the market and avoid ranging conditions is very, very, very important. Step 2, liquidity raid. Let's say that we're bullish in the market. Then we want to see sell-side liquidity taken out, and this would be the Asia or London session low. So let's say we're bullish, we have a long daily directional bias, and let's say that this is the Asia or London session low right here. Then we need to see a raid of sell-side liquidity before we can look for a potential buy position in the market, because we need to see sellers be trapped in this market. We understand that a lot of dumb money will be executing during this range right here. And smart money is looking at buying these sell stops below this sell side liquidity once we've stopped out lots of traders in the market. Vice versa, let's say that we're bearish in the market. We need to see buy side liquidity taken out. This could be the Asia or London session high. And so if we are bearish in the market, let's say this is the London or Asia session high right here, then we need to see price trade higher before we can look at shorting this market right here. So a lot of dumb money in the market will be executing during this range right here. And then smart money would be looking at shorting this market once we've raided buy side liquidity, looking at targeting sell side liquidity to the downside right here. Step 3, confirmation. Let's say that we're bullish in the market. So this is based on condition number 1. We've seen that the EMAs are in order. We've then seen a liquidity raid. So we've seen a raid of sell side liquidity. And now we need to wait for a bullish 15-minute candle closure during a kill zone. We then want to enter on the break of this 15-minute bullish candle high. So let's say that we're long bias. We've raided sell side liquidity. We then need to see a 15-minute bullish confirmation. And let's say that this is the 15-minute bullish candle high. We then want to enter a buy position on the break of this high right here. This would be a 15-minute bullish confirmation. It's very important that this has to occur during a kill zone. So this could be during the London or New York kill zone. let's say that we have a bearish daily directional bias, then we need to see a bearish 15-minute candle closure during a kill zone. We can then enter on the break of this 15-minute bearish candle low. And so that would look something like this. Let's say that we are sell bias. We see a rate of buy side liquidity. We're looking for a 15-minute bearish confirmation. We can then enter on the break of this 15-minute candle low. And this has to occur during a kill zone. In terms of session and kill zone timings, this is very, very, very important. We have the New York kill zone, which is between 8 a.m. and 10:30 a.m. Eastern. And we're only looking at executing trades during this time window right here. And we also have the London session kill zone, which is between 3 a.m. and 5 a.m. Eastern. And it's super important that we only execute trades during this window right here. Like, I remember when I was a losing trader and I first started trading, I had no idea about session timings in the market. And I remember just entering trades randomly across the day. However, when I started to implement specific time windows to trade, I then became a lot more calm in the markets. Like, I remember being sat up at 12 o'clock midnight, and I remember being sat up in my dressing gown at 1 a.m. in the morning, trying to trade the Asia session with no trading plan. And I remember my partner getting pretty angry with me at the time. And what I realized is I didn't even have a trading plan, and I was trying to randomly enter the market outside of these kill zone windows. And so if you can implement these sessions where you can sit down at the market, it really helps for trading to revolve around your life rather than your life revolving around trading. And so implementing these exact session kill zones actually made me a lot more calm in the markets. Okay, step 4, stop loss and targets. Let's say that we have a bullish daily directional bias and we've seen our 15-minute bullish confirmation. Then where do we place our stop loss? And this is very, very important that you stay mechanical with your stop loss placement. I remember 7 years ago, I literally placed this gold trade in the market and I didn't even have a stop loss. I wasn't aware of a clear invalidation in the market and I didn't even know how much I was risking. And I literally remember blowing over $2,000 in about 3 seconds in the market. And this was one, because I didn't have a accurate stop loss placement and I didn't have a clear invalidation on my trade. And so let's say that we get a 15-minute bullish confirmation here. We want to enter on the break of this high of the candle. Invalidation always goes at the low of the liquidity sweep. And it's very, very important that you always account for spread in the market. So let's say that you're trading the US 500. Let's say that the spread is 0.5. Then you need to account for that spread in your stop loss. Otherwise, you may get stopped out and then price moves in the intended direction. So always account for spreads at the low of the liquidity sweep, because the last thing that you would want in the market is being stopped out and you had direction absolutely correct and then price goes on to hit your take profit. And so even if you're entering a buy position right here, you need to account for spreads at the high of the 15-minute bullish candle. This ensures that you're triggered in when we actually break the candle high, because the last thing that you'd want is to be triggered in when we haven't actually broke the candle high and then price goes on and hits your stop loss. And if we are bullish in the market, we have a bullish target at a 1 to 2 risk to reward. So stop loss goes at the low and then we always target a mechanical 1 to 2 risk to reward. Vice versa, let's say that we have a shorting opportunity. We get a 15-minute bearish confirmation. We can enter on the break of this candle low right here. Invalidation always goes at the liquidity sweep high, and then make sure to account for any spreads above this high, because the last thing that you would want is price to tap this high and then hit your take profit, but you would have been stopped out if you didn't account for spreads at this high right here. And our bearish target is still a mechanical 1 to 2 risk to reward. So let's say that we're triggered short in this trade right here. You're looking to target a 1 to 2 right here. Okay, so this right here is the exact momentum mastery blueprint that I personally trade every single day in the markets. And this right here is a fully rules-based mechanical system that takes all of the guesswork out of the markets. So we're currently looking at GBP USD on the 15-minute time frame. Okay, so step one is daily directional bias. What is the draw on liquidity? You can see right here the 50 EMA is less than the 100, which is less than the 200. So this indicates that we are sell bias on this market. The draw on liquidity is to the downside. I remember when I first started trading ICT concepts, I found it so hard to actually identify my daily directional bias. And often I found I was identifying it in a very subjective manner. And so using the EMAs like this is just a very, very simple way to identify what is the draw on liquidity. Are we looking for shorts today or are we looking for longs today? So we're short bias on this market right here. We then need to identify an area of buy side liquidity. And so we have buy side liquidity resting above this London session high. I've just removed the EMAs, but please keep in the back of your mind that we are sell bias on this market. So what you're going to find is dumb money is going to be accumulating within this range right here. And then smart money is going to be looking at shorting once we've run the buy side liquidity. So we ran sell side liquidity to the downside, but that's not too important because we understand that the draw on liquidity is to the downside because we still need to see buy side liquidity taken out before we can look for a shorting opportunity. So we raid buy side liquidity right here. This is during a New York kill zone. So for anyone wondering, New York is between 8 a.m. and 10:30 a.m. Eastern. London is between 3 a.m. and 5 a.m. Asia is 7 p.m. until 12 o'clock midnight. So now we're waiting for step 3, which is our confirmation. So this is your 15-minute bearish confirmation right here. We can then enter a sell position on the break of this 15-minute candle low. So the sell stop would be placed right here. Invalidation always goes at the high of the liquidity sweep, accommodate for a little bit of spread, and then look at targeting a 1 to 2 risk to reward. And we could easily drop down to the 1-minute time frame here and have a look for breaks of market structure on the 1 minute or inversions of bullish fair value gaps. But I'm here to tell you that you do not need to do that. I remember when I first started trading ICT concepts, I used to get so emotional on the 1-minute time frame. The time frame is just so noisy. There's so much going on. And at the time, it was just not suitable for my lifestyle. Anybody that's working a full-time job or education will find it extremely hard to trade on the 1-minute time frame over the long term. And so you don't need to be dropping down to the 1-minute time frame to identify these market structure shifts or inversions of fair value gaps. You can just take the trades based off 15-minute momentum stepping into the market. And so you're triggered short in this trade right here, and it's literally either stop loss is hit or take profit is hit. You never want to be micromanaging your positions. And as you can see, just before the Asia session, this trade did hit take profit for a 1 to 2. So let me just summarize this trade right here. Step 1, daily directional bias with sell bias. Step 2, we've seen a raid of buy side liquidity. Step 3, we've seen a confirmation. Step 4, stop loss and targets. And then it's down to you to be very, very disciplined in the market, to not micromanage your trades, and to just allow the trades to play out. At the end of the day, you've executed an A+ setup. And so this right here is the momentum mastery system using my exact blueprint right here. And so honestly, guys, my trading was an absolute mess until I took the time to fully define my rules-based system to help take all of the guesswork out of it. And at the end of the day, I'm not here to tell you what sort of system you should be trading. People are successful with discretionary systems, with rules-based systems, but I'm just here to share with you my experience and what's personally worked for me. And so if you want to see me trade this live every single day in the markets, and you want to learn more about this fully rules-based mechanical trading system, then make sure to check out my exclusive community in one-on-one mentorship. The link is in the description down below. So thanks so much for your time and support, and you take care, guys. Bye-bye.